July 18, 2025, a date that could mark a turning point in China's economic story. China stands at a crossroads, both literally and figuratively. The world's second-largest economy faces choices that will shape not just its own future, but the global landscape as well. For decades, China's economy seemed unstoppable. Rapid urbanization, relentless manufacturing, and a booming export sector lifted hundreds of millions out of poverty. Cities grew at lightning speed, and China became a symbol of growth and ambition. But now, the momentum is fading. Economic growth has slowed to levels not seen in generations. Retail stores sit empty, factories cut back production, and financial analysts watch the numbers with growing concern. Uncertainty is everywhere. The big debate now centers on a single radical idea. Should China's central bank slash its main interest rate all the way to zero? This is known as ZIRP, zero interest rate policy, a move that would have been unthinkable just a few years ago. The United States and Japan have both used this policy during times of crisis, hoping to jumpstart their economies. For China, adopting ZIRP would be a dramatic shift, signaling a willingness to try bold, unconventional tools. Supporters argue that zero rates could be the only way to reignite growth. Cheaper borrowing would help businesses invest, families buy homes, and consumers spend more, all of which could breathe new life into the economy. It could also ease the burden of massive local government debts, making it less costly for cities and provinces to manage their obligations and fund public projects. But critics warn that this is a dangerous gamble. They point to the risks of unintended consequences and the possibility of long-term damage. Japan's experience is a cautionary tale. Despite years of zero rates, Japan struggled with decades of stagnation, deflation, and a lack of confidence in the future. Opponents fear that zero rates could hurt banks' profitability, punish ordinary savers who rely on interest income, and undermine trust in the financial system. There's also the risk of fueling dangerous bubbles in real estate and stocks, as cheap money chases risky investments. The stakes are enormous. China's decision will not only shape its own destiny for years to come, but could send shockwaves through global markets, affecting economies everywhere. In Beijing, the debate is fierce, and the pressure is intense. Policymakers weigh the risks and rewards, knowing there are no easy answers and no guarantees. What China decides next could change everything, for itself and for the world. What is a zero interest rate policy, or ZIRP? It's a term you might hear in the news, especially when economies are facing tough times. But what does it really mean, and why does it matter so much for countries like China? To understand ZIRP, think of interest rates as the price tag on borrowing money. When you take out a loan, you pay interest, essentially a fee for using someone else's cash. The higher the rate, the more expensive it is to borrow. The lower the rate, the cheaper it gets. The central bank, like the People's Bank of China, sets a key interest rate that acts as a benchmark for all other rates in the economy. This single decision ripples out, affecting everything from mortgages and business loans to credit cards and savings accounts. When a country adopts a zero interest rate policy, it means the central bank slashes that main rate all the way down to zero, or as close as possible. Suddenly, borrowing money becomes almost free. The hope is that this will encourage people and businesses to spend, invest, and take risks, breathing new life into a sluggish economy. Japan was the first major economy to try this experiment in the 1990s, after its asset bubble burst and growth stalled. The result? Japan avoided a total collapse, but the economy never fully bounced back. Instead, it entered a long period of weak growth and stubbornly low inflation, a phenomenon now known as Japanification. For decades, Japan's economy has struggled to regain its former dynamism. The United States also turned to ZIRP after the 2008 global financial crisis, when banks were failing and unemployment soared. The Federal Reserve cut rates to near zero and kept them there for 7 years. This made it easier for businesses to borrow, for families to buy homes, and for investors to take chances. The policy helped stabilize the economy and set the stage for a long recovery. But there's a key difference between the US and Japan. The US eventually managed to raise rates again as growth returned and confidence improved. Japan, on the other hand, has remained stuck at zero, unable to break free from its economic malaise. ZIRP is a powerful tool, but it comes with serious risks. It can help a country weather a crisis, but escaping from zero can be incredibly difficult. If people and businesses get used to free money, it can be hard to return to normal. There's also the danger that ZERP can create bubbles in real estate or stocks, or encourage too much risky borrowing. If not managed carefully, it can lead to new problems down the road. For China, the experiences of Japan and the US serve as both a warning and a lesson. ZERP can be a path to recovery, but it can also trap an economy in stagnation if used for too long or without other reforms. The decision isn't just about setting interest rates, it's about shaping the future China wants, whether that means bold reforms, encouraging innovation, or risking the comfort of easy money for long-term growth. Will China follow the US path, using ZERP as a springboard to recovery and then moving on? Or will it risk repeating Japan's experience, where zero rates become a permanent fixture and growth remains elusive? ZERP is not a magic bullet, it's a powerful but double-edged tool, with the potential for both revival and regret. As China weighs its options, policymakers must carefully consider the risks and rewards, learning from the successes and failures of others. The world is watching closely, because the path China chooses will shape not just its own future, but the global economy as well. The stakes have never been higher. Every decision now could echo for decades. This is the crossroads China faces today, a moment of choice that will define its economic destiny. Why is China even considering zero interest rates? It's a question that would have seemed unthinkable just a few years ago, when China's economy was booming and growth seemed unstoppable. But now, the world's second-largest economy is facing a set of challenges so severe that policymakers are being forced to consider options once thought radical. The answer? A perfect economic storm is brewing, threatening to upend decades of progress and stability. For the first time in years, China faces deflation, falling prices that make people delay spending, stalling the economy. When consumers expect prices to drop further, they hold off on purchases, hoping for better deals in the future. This behavior slows down economic activity, making it even harder for businesses to grow and hire. Growth has slowed sharply, and consumer spending is weak. Shops and restaurants that were once bustling are now seeing fewer customers, and the mood on the streets is noticeably more cautious. People are saving more, worried about jobs and the future. Uncertainty about employment prospects and the overall direction of the economy is causing families to tighten their belts, putting off vacations, big purchases, and even everyday spending. The property market, once a growth engine, is in crisis. Construction sites have gone quiet, and the real estate sector, which used to drive so much of China's economic miracle, is now a source of anxiety. Developers are drowning in debt, projects are unfinished, and home values are falling. Many companies that once seemed invincible are now struggling to survive, and the ripple effects are being felt across the economy. With so much family wealth tied to real estate, falling prices make people feel poorer and less likely to spend. For many, their home is their biggest asset, so when its value drops, confidence in the future drops too. High real interest rates, because of deflation, make borrowing expensive, even as the official rate drops. This means that loans for homes, cars, or businesses are harder to afford, further slowing economic activity. Businesses hesitate to invest, and families hold off on big purchases. Entrepreneurs are reluctant to expand, and consumers are wary of taking on new debt, creating a climate of caution and restraint. The result? A vicious cycle of weak spending and weaker growth. Each problem feeds into the next, making it harder for the economy to recover and for confidence to return. All these problems are colliding at once, creating a sense of crisis that is hard to ignore. News headlines are filled with stories of economic trouble, and the mood across the country is increasingly anxious. That's why the radical idea of zero interest rates is suddenly on the table. Policymakers are searching for bold solutions to break the cycle and restore growth, even if it means rewriting the rules. China's leaders are searching for a way out of this storm. The choices they make now could shape the country's future for years to come as they try to steer the economy back to calmer waters. Some in China say it's time for bold action: cut rates to zero and jolt the economy back to life. Zero rates would make borrowing cheap for businesses, fueling investment in factories, technology, and jobs. For families, mortgages and loans would be more affordable, helping stabilize the property market and boost spending. Supporters argue this is the medicine China needs to fight deflation and revive growth. Lower rates would also ease the debt burden on local governments, freeing up money for public services. They say gradual cuts aren't enough. A dramatic move is needed to change expectations and restore confidence. Going to zero, they argue, would send a powerful signal. China is serious about turning things around. It's a high-stakes bet on optimism and recovery. But critics warn, look at Japan. Decades of zero rates didn't bring real recovery. The danger? Even at zero, people and companies may not borrow or spend if confidence is low, a liquidity trap. Banks suffer too. With tiny margins, profits shrink, making them less willing to lend, hurting the economy further. Savers, especially retirees, lose income. Instead of spending, they may save even more, dragging demand down. Zero rates can also fuel risky bubbles in stocks or property, as people chase higher returns. Another risk, zombie companies survive on cheap loans, tying up resources that could go to healthier firms. Critics fear ZIRP could trap China in stagnation, just as it did Japan. The lesson: zero rates are no guarantee of growth, and may bring new problems. Many experts urge caution. Instead of ZIRP, they suggest a mix of targeted tools. Gradual, focused rate cuts could help key sectors like small businesses, without risking the whole system. Fiscal policy, more government spending, tax cuts, or direct cash to households, could boost demand more effectively. Deeper reforms, like improving social safety nets or breaking up monopolies, could unlock long-term growth. Combining modest rate cuts, fiscal stimulus, and structural reforms offers a safer, more balanced path. This approach addresses both immediate pain and long-term challenges, without the risks of zero rates. China doesn't have to gamble everything on one policy. China's decision won't just affect its 1.4 billion people, it will ripple across the globe. Zero rates could weaken the yuan, making Chinese exports cheaper, but hurting competitors and risking currency wars. Investors might pull money out of China, shaking global markets. If China revives its economy, demand for raw materials and goods will surge, lifting countries worldwide. But if China stagnates, global supply chains and major companies could suffer, dragging down growth everywhere. Policymakers worldwide are watching Beijing's next move. The world's economic future is tied to China's choice. China faces two stark futures. One path: bold action, zero rates, and a bet on rapid recovery, restoring growth, stabilizing property, and avoiding Japan's fate. The other caution: targeted support and deep reforms, protecting savers, banks, and long-term stability. The first is fast but risky. The second, slower but more sustainable. Each path has passionate advocates and real dangers. The choice is about more than interest rates. It's about the kind of future China wants. The world is watching which road China will take. China stands at a historic crossroads. The zero-rate path promises quick relief but carries big risks. Japan's experience is a warning. The alternative, gradual reform and targeted support, demands patience but may build a stronger foundation. The decision will shape China's destiny and the global economy for years to come. Will China gamble on ZIRP or choose a steadier course? The world waits for the answer. The stakes could not be higher.